Time value of money, TVM, is the idea that a dollar today is worth more than a dollar tomorrow because the dollar today can be invested to earn interest. Think of it like a growing tree. A sapling today can be watered and will become a tall tree later, while a seed you plant next year starts later and will be smaller at the same future date. The two core relationships are: future value FV is how much a present amount PV will grow after n periods at a periodic interest rate I formula. Future value equals present value times open parenthesis 1 plus I close parenthesis raised to the n. Present value PV is how much a future amount is worth today when discounted at rate I formula. Present value equals future value divided by open parenthesis 1 plus I close parenthesis raised to the n, which is also future value times open parenthesis 1 plus I close parenthesis to the minus n. If I equals 5% per year and you have $1,000 today, in 3 years the future value equals 1,000 times open parenthesis 1.05 close parenthesis raised to the 3, approximately $1,157.63. Conversely, $1,157.63 received in 3 years is worth present value equals $1,157.63 divided by open parenthesis 1.05 close parenthesis raised to the 3, approximately $1,000 today. The concepts are the building blocks for every valuation in corporate finance. A single cash flow is a lump sum payment that occurs once either today present value or in the future value. The same formulas as above apply, but we illustrate with concrete numbers. Example 1: future value: invest $5,000 today at an annual rate of 8% for 5 years. Future value equals 5,000 multiplied by 1.08, raised to the 5th power approximately $7,346.64. Example 2: present value: you will receive $12,000 in 4 years, and the market discount rate is 6% annually. Present value equals 12,000 divided by 1.06, raised to the 4th power approximately $9,516.56. If the cash flow occurs mid-year, adjust n to reflect fractions, for example 2.5 years. The key is matching the compounding period annual, semi-annual, monthly, with the rate convert I accordingly. I month equals annual I divided by 12. Cash flows that repeat over time are called annuities. An ordinary annuity pays at the end of each period, while an annuity due pays at the beginning. A perpetuity never ends, and a growing annuity increases each period by a growth rate g. Present value equals C times open bracket 1 minus open bracket 1 plus I close bracket to the negative n power close bracket divided by I, where C equals cash flow each period. Example: receive $2,000 each year for 6 years, discount rate 9%. Present value equals 2,000 times open bracket 1 minus open bracket 1.09 close bracket to the negative 6 power close bracket divided by 0.09, approximately $9,358. Perpetuity: present value equals C divided by I. If a firm promises a $500 dividend forever and the required return is 7%, present value equals 500 divided by 0.07, approximately $7,143. Present value equals C times open bracket 1 minus open bracket 1 plus G close bracket over open bracket 1 plus I close bracket to the n power close bracket divided by open bracket I minus G close bracket. If cash flow starts at $1,000, grows 3% annually, lasts 10 years, and I equals 8%, present value approximately $8,208. Derivations come from summing a geometric series. The formulas collapse the series into a compact expression, saving time on exams. The discount rate reflects the opportunity cost of capital and risk. It is built from cost of debt, KD, after-tax rate equals interest rate times 1 minus tax rate. Example: 6% loan, 30% tax, KD equals 6% times 1 minus 0.30 equals 4.2%. Cost of equity, KE, often estimated with the capital asset pricing model, CAPM KE equals RF plus beta times RM minus RF. RF is risk-free rate. Beta is stock's volatility relative to market. RM minus RF is market risk premium. Weighted average cost of capital, WACC, equals E divided by V times K E plus D divided by V times KD, where E is market value of equity, D is market value of debt. V is E plus D adjust for preferred stock if present. Risk-adjusted rates. For a project in a risky country, add a country risk premium. For a division with higher than average risk, raise KE accordingly. The discount rate is the hurdle rate against which NPV is measured. Net present value NPV is the sum of all discounted cash flows, both inflows and outflows. NPV equals sigma CF sub t divided by 1 plus R to the t, where CF sub t is cash flow at time t and R is the discount rate. Decision rule: accept the project if NPV is greater than 0, value added. Reject if NPV is less than 0. Internal rate of return, IRR, is the rate R that makes NPV equal to 0. Solve sigma CF sub t divided by 1 plus IRR to the t equals 0. Decision rule: accept if IRR is greater than the required rate, WACC. Multiple IRR problem occurs when cash flow signs change more than once. For example, an initial outflow, then inflow, then another outflow. The NPV equation becomes a higher-order polynomial, producing several real roots. In such cases, rely on NPV or use modified IRR, MIRR, which assumes reinvestment at WACC. Project costs $100,000 now, returns $40,000 each year for 4 years. With R equals 10%, NPV equals negative 100,000 plus 40,000 divided by 1.1 plus 40,000 divided by 1.1 squared plus 40,000 divided by 1.1 cubed plus 40,000 divided by 1.1 to the fourth power. Approximately $7,160, except IRR approximately 12.6%, found by trial and error or financial calculator. Real-world cash flows rarely line up perfectly with year-end. Adjustments include uneven cash flows. Discount each cash flow individually using its exact timing t in years or fractions. Example, $5,000 received after 9 months, 0.75 years at 8%, present value equals 5,000 divided by 1.08 raised to the power 0.75, approximately $4,658. Continuous compounding. When interest compounds continuously, use e to the RT future value equals present value times e to the RT. Present value equals future value divided by e to the RT. Example, $1,000 today, R equals 5% continuous for 3 years. Future value equals 1,000 times e to the 0.05 times 3, approximately $1,161.83. Day count conventions. Financial markets use conventions such as actual over 365, 30 over 360, or actual over actual to convert days into years. For a loan from January 15 to April 10, 85 days using 30 over 360, t equals 85 divided by 360, approximately 0.236. Using actual over 365, t equals 85 divided by 365, approximately 0.233. These nuances are often tested on exams. Using the correct t prevents small but exam-killing errors. Sensitivity analysis tests how NPV or IRR reacts when the discount rate changes. Create a table showing NPV at R equals 6%, 8%, 10%, 12%, etc. The slope delta NPV over delta R indicates the project's riskiness. Steep decline means high sensitivity. Scenario analysis goes further by varying multiple inputs simultaneously. For example, revenue growth, cost of capital, tax rate. Build best case, base case, and worst case scenarios and compare NPVs. Example, base case cash flows yield NPV equal to $20,000 at 9% discount. If rate rises to 12%, NPV falls to $5,000. If rate drops to 6%, NPV climbs to $35,000. This helps managers understand the range of outcomes and decide whether to proceed or seek hedges. Explanation: when multiple projects compete, exams often ask which method is best. NPV measures absolute value added. Choose the project with the highest positive NPV. Equivalent annual annuity, EAA, converts a project's NPV into an annuity over its life, allowing comparison of projects with different lengths. EAA equals NPV times R divided by 1 minus 1 plus R to the minus N. Choose the higher EAA. Payback period calculates how long it takes to recover the initial investment without discounting. Simple but ignores time value and cash flows after payback. Exam tip: if asked for the financially superior project, always prioritize NPV unless the question explicitly states equal capital constraints and different lifespans, in which EAA is appropriate. Payback is only used for rough liquidity screening. Example: Project A, NPV $30,000, 5-year life. Project B, NPV $28,000, 3-year life. At 10% discount, EAA equals $30,000 times 0.1 divided by 1 minus 1.1 to the minus 5, approximately 7,880. EAAB equals $28,000 times 0.1 divided by 1 minus 1.1 to the minus 3, approximately 9,896. Even though it has a higher NPV, B's higher EAA makes it preferable if the firm can reinvest cash every 3 years. Explanation: exam traps are often about misapplying formulas or overlooking calendar details. Wrong timing: using N equals number of periods instead of actual fractional periods for mid-year cash flows. Mixing nominal and effective rates: if interest is quoted nominal, a PR with semi-annual compounding, the periodic rate equals a PR divided by 2, not a PR divided by 12. Calendar versus fiscal year: companies may have a fiscal year ending June 30th. Cash flows tied to fiscal periods must be aligned with the discounting timeline. Ignoring tax shields: when computing after-tax cash flows, forgetting to deduct depreciation tax shield leads to overstated NPV. Multiple IRR: reporting the highest IRR without checking sign changes. The correct approach is to use NPV or MIRR. A good habit is to write a quick checklist before calculation. Identify timing, choose correct rate, nominal or effective, adjust for taxes, and verify cash flow sign pattern. Real-world valuations must adjust for inflation, taxes, and foreign currency. Inflation: use nominal cash flows and nominal discount rate, or convert both to real terms. Real rate: approximately 1 plus nominal divided by 1 plus inflation minus 1. Example: nominal rate 8%, inflation 3%, real rate approximately 4.85%. Taxes: compute after-tax cash flow equals revenue minus expenses times 1 minus tax rate plus depreciation times tax rate, depreciation shield. Include tax impacts on both operating cash flows and terminal value. Currency effects: when cash flows are in a foreign currency, either option A, convert each cash flow to the firm's reporting currency using the expected future exchange rate, or option B, discount in foreign currency using foreign risk-free rate plus country risk premium, then translate the discounted value at the current spot rate. Example: project in euros expects 1,000 euros each year for 3 years. Expected euro to US dollar rate will be 1.10, 1.12, 1.14. Discount using euro area weighted average cost of capital 7%. Present value in euros equals the sum of 1,000 euros divided by 1.07 to the t power. Then convert present value euros times the current spot rate, for example 1.08 to US dollars. In exam questions, look for clues. All cash flows are in real dollars, or tax rate is 30% and depreciation is straight line. Apply the appropriate adjustments before running net present value or internal rate of return calculations.